Well, good morning, everyone. Thomas Montgomery with IIMFL and Smart Money Alliance. It's a pleasure to visit with you this Friday morning, April 2nd. It's Good Friday. A couple of housekeeping issues, and then we'll get to the training agenda for today. The programmer, Scott, has now completed the new front-end system for submitting access to capital clients. So now we just simply need to roll it out, and so we'll be rolling it out next week. We thought it'd be a little sooner. There's always those last minute tweaks, but he's done with his end and it's operational. So we'll be getting word out to you all here soon next week about that new front end system. It will allow you to feed in clients more efficiently and get better feedback for the access to capital. So more news on that next week, but the good news is the programming part is finished. And then secondly, we'll be calculating month-end commissions here over the next couple of days now that we're closing out the month of March. Thirdly, we have a really exciting topic I think we'll be ready for on Monday, addressing the 3 C's in a little bit of a different perspective. So if you can join us Monday morning, that'd be great. If not, we'll of course record it. So with all that being said, our agenda is shown on the screen. I'm going to make it a little bit larger. We won't be able to see the full page. So over the past year, with the pandemic and the changes in the lending and credit marketplace, there's not been consistency in real estate finance. But now I believe we're back to more of a stable state, and we're going to talk about a number of different 100% real estate financing options. So we're going to go through and be very transparent and be very clear on how these work. So I don't want it to be misperceived, because in some cases, the 100% financing comes from a two tranche capital raise. But let's go ahead and get started. And these are not listed in any specific order, but I will tell you, this is probably the hottest industry. We have more clients that come to us through the Capital Ready Package 3.0 and or access to capital for real estate financing than any other use. And so if you can assimilate this and then spread the word effectively, I do believe that you'll have an incredible April by helping clients with 100% real estate financing options. Again, it's not a standalone product or program. It's a source of funding for clients that enroll in either access to capital and or Capital Ready 3.0. Okay, so let's start with SBA. You all know the story. I worked for the SBA, or was paid under an SBA grant up until, what was it, July 5th of 99. So we did a lot of SBA 504 loans. There's different types of SBA loans, but 504 is meant for real estate or hard assets. It's not working capital loans. So it's not unusual that we'll apply for 2 loans for clients, one for the real estate and a different one for working capital. The SBA will guarantee up to $5 million. And then you've heard this before, but just be clear. So we're technical advisors, you and I, we're technical advisors. We are not the lenders. We're not the bank. And in this case, the truth is the SBA is not the lender, not the bank. They're the guarantor. So we're going to have to take this through a bank, and we've got some preferred relationships, but really we can work with any SBA lender. So the SBA will guarantee up to $5 million. So does that mean that that's the cap that the loan could be? Absolutely not. But the SBA itself will go up to a $5 million guarantee. The repayment terms 10 to 20 years, which you'd expect for big ticket items. Now, those payments are still not going to be cheap, right? You borrow $5 million, even a low interest rate, they're not going to be cheap payments. But as you and I know, it's all about ROI, return on investment. If we're borrowing money, we're anticipating putting that money to good use and being able to generate excess profit from that investment. Otherwise, we just skip the whole process. And again, just as the title today, 100% financing is available, but that's only going to be available through a 2 tranche capital raise. So, and you're going to see that through a number of these different loan options. So let's dig into that. So if you look up, you Google SBA 504 loan, will they finance 100% of the project? No, They won't. They're going to require some contribution by the borrower. The amount can vary, and based upon how the loan package is built, it could be less than more. So I am not saying, and please don't misinterpret, I'm not saying that the SBA or the SBA lender will loan you 100% of the real estate financing, because they won't. They're going to expect some equity contribution. What I'm describing is we can break it into two tranches. So first, we do a capital raise that's going to create the equity contribution, and then we go get the SBA guaranteed 504 loan. Make sense? So two tranches. First, we create our contribution, and then second, then we apply for the SBA guaranteed 504 loan. Now, the SBA has some specific requirements, really more than the others. So that's why I thought I would mention them. This can be for the purchase or construction of existing or new. I mentioned to you one of the last big deals that we did before I left the SBA was an $8.2 million project. It was a soccer park, partially indoors, partially outdoors. And it was a ground up build, so we had to go acquire the land and then get the land, the dirt work done so it was suitable for building, and the drainage and getting the contractor's bids, 3 different bids to erect the facility and so forth. So it can be just simply a concept that we're going from the ground up, or it could be to buy existing buildings or land. Because again, we're talking about real estate financing, and 504 is for hard assets. It could be for equipment. That's not what we're talking about today. So this is for real estate, not working capital. So it's not for, speaking of that, it's not for working capital or inventory. We can go get a 7A SBA loan to provide working capital or inventory money, but not the 504 specifically for the hard asset. And it cannot be used for consolidating, repaying, or refinancing debt. And it cannot be used for speculative or real estate investment. So let's say that we want to go buy an apartment building or build an apartment building in either case. Can we use a 504 loan for that? No, because that's considered speculative. And what that means is that you're making the assumption, and it may be a reasonable assumption, but you're making an assumption that we're going to not use it ourselves, but rent or lease portions of it and generate income. The nice loophole is this, is that if we're going to buy or build a commercial office building, as long as we're going to use, quote unquote, 51% of it or more for our business, then the SBA 504 guarantee will work. But we can't go out and buy like rental houses with SBA 504 loans, for example, or we couldn't buy an office building that we're not going to quote unquote use at least 51% for our own use. So SBA doesn't do speculative real estate. A couple requirements, and again, I want you to read these closely because if you just skim these, you're going to misinterpret. So it has to be a for-profit US-based company, no surprise there. You have to have tangible net worth of less than 15 million. If you're worth more than 15 million, you can't qualify for an SBA loan. So again, listen carefully. We're not saying that you have to have 15 million or more. It's just the opposite. We're saying that you would be excluded if you're worth 15 million or more. And then lastly, your net income must be less than $5 million after federal taxes. So is that a minimum? It's the opposite of that. That's the maximum. The SBA was set to do financing for small businesses. And so here's some of the definition of small businesses to qualify for a 504 loan. Okay? So that's one of several 100% financing real estate options that we would like to partner up with you and help many clients today and going forward with. So that's the first. Now, keep in mind, you do not need to be an expert in these loan programs. Really, you shouldn't be consulting with the clients of, well, I think a 504 would be best for you. Instead, what you would do is focus on the concept hey, we have some 100% financing real estate options available. Let's get you enrolled today in either the access to capital, no upfront guaranteed financing, or the Capital Ready 3.0, pay the $2,500 upfront, get a few perks. So again, don't misinterpret the purpose of this training. We're training you as our distribution partner so you have greater awareness, but I would not encourage you to start consulting with clients on specific funding options, because you may miss something. You may create expectations that the client's going to get something that they can't qualify for, or that they're not best qualified for. Okay, so that is number one. That's great. Number two, alternative long-term real estate financing. So obviously SBA is a great way to go, but not all deals will meet SBA terms. So if that's not the case, we can use alternative long-term real estate financing. This works for commercial and real estate properties. And we've seen many of these deals where, let's take someone wants to buy a house for themselves or their family. Let's ignore rental properties. We're just going to use kind of an extreme example, but a real one. My neighbor did this. So wanted to buy $360,000 house, frankly, didn't qualify, didn't have the income verification, but wanted that house. Well, we can use alternative real estate financing. So we buy the home for quote unquote rental purposes. But what happens if you don't rent it out and you just move into it? Well, you found a back door to get a better house for you or your family. And that's not the core intention. The core intention here is to buy commercial or residential investment properties. It has a floor. They won't do below 100,000, which with today's escalating real estate prices, that's probably not going to be too big of a barrier. But some of you are in some depressed markets like Detroit and that, where you can go buy properties even cheaper than that. But unfortunately, the floor is 100,000. Can be used to purchase or refinance, which is great. Again, 100% financing available. So again, we would do a stacked capital raise, just like I described a moment ago. This has a nice 30-year repayment term, so can't complain about that. And of course, well, I'll come back to taxes in just a second. Simplified underwriting. We do not have to verify income, assets, or tax verification. So this is great. This is one of those that pretty much anyone will qualify for. Now, the building has to appraise out for what we're trying to buy it for. Of course, that would be irrational otherwise, but you're not going to run into personal barriers for the alternative real estate financing as you might in other options. Okay, what I wanted to mention though is, and again, this is a twist on it, and I'm probably overemphasizing it, so it may distract us, but take someone, they want to own a home. They're tired of renting an apartment or a mobile home or a townhome. They're tired of living with family. They want to own their own home, but they don't meet mortgage criteria. This is what they would probably use. Oh, I'm going to go buy that house to be a rental income house, quote unquote. They just never rent it out. They end up moving into it. Because if they say they're going to move into it, then it's going to meet primary residence requirements, and now it falls into traditional mortgages, which we don't do. But if it's a commercial property, they can do this, and now they don't have to verify income. There's just minimal requirements for it. So it's a great way. And you could do this over and over and over. Of course, you probably wouldn't live in all those houses, but this is a great option for people that don't meet, or deals that don't meet traditional financing. Okay, now we're on to number 3, fix and flip. So this is kind of the buy and hold concept here. Now, you don't have to keep it for 30 years, but it's not intended to just fix and flip, which is the next. So fix and flip, again, works for commercial as well as residential buildings. Floor that they've set is a minimum of 100,000. It's just not worth their time to do the paperwork and effort if it's less than 100,000. And certainly, again, 100% financing is available. That's the topic today, 100% financing real estate. And so you're going to see that's the case on each of these, because that's why they're on the page here. So fix and flip means that you're looking to turn it around in a short order instead of having a long term. And in some cases, we can see interest only fix and flips where you don't even have to pay the principal. That makes the payments even less. Okay, so then we get to number 4, private lender financing, again, for commercial and or residential investment properties. they've got a floor of at least 200,000, purchase or refinance, and again, 100% available. So to reiterate, it's not your burden and it's really not your responsibility to go figure out which type of financing is best for a client. We're not training you to that degree, and the market's changing. And so it's unlikely, unless this is your industry, that you're going to be proficient enough to be able to make good recommendations. So again, to reiterate, what you'll want to do is take to the market, hey, our 501c3 nonprofit has a no upfront cost program called Access to Capital. We have the ability to get you 100% real estate financing, and again, no upfront cost, and we guarantee results. Okay, so then now let's scroll on down to the last, and this is maybe the most complicated, maybe you would even argue is the most convoluted. So, but hear me out. So we could well, let's stop for a second. So is there collateral for a 504 loan? Yes, the building that we're buying or building. Is there collateral under the alternative long-term real estate financing? Yes, the real estate that we're buying, or I guess building. Is there collateral requirements for fix and flip? Sure, the property that they're loaning you the money on is pledged. So in each of these cases, there's collateral, not that you have to bring to the table, but what we're buying, we're pledging. And that's true, if you and I go down to the car dealership, right, and we buy a new Jeep. Well, is there collateral on the Jeep loan? Yeah, the Jeep. If we don't pay the note, the payment, the monthly payment on the Jeep, then they're going to repossess it probably in the middle of the night. So with real estate, the nice thing about real estate is it's easy to get financing on because it serves as its own collateral, right? So it's beautiful. Okay, so now we're going to get to indirect, and I went back and digressed because this is unsecured. So in this case, if we use indirect financing, you own the deed. You have the title to the property outright. There is no lien against it. It's 100% yours. And there's a few benefits to that, of course. So again, this could be used to buy real estate that is commercial or residential real estate that you're going to live in or use as an investment property. It's not restricted, is my point, because there's no lien against it. The property is not collateral on the deal because it's unsecured. So that was a point here in the second bullet. Now, if you wanted, you could go buy a property with unsecured financing. There's no lien against it. Then if you wanted to, I'm not recommending it, but you could then turn around and then put a mortgage on it. And of course, then that would give you additional cash. So that's an option, not a requirement, not pushing for that. And again, 100% financing is available. So you'll see the theme, 100% financing on each. Many of these we're able to obtain, again, for clarity, 100% financing because we're using a 2-tranche raise. And so you'll see that on many of these, not all of these, but many of these. The indirect is not a 2-tranche because the second tranche in each of these is some modified mortgage, if you will, because a mortgage in a general sense means we're borrowing money to buy real estate and the real estate is being used as collateral. So the second tranche is tying the loan to the asset itself. The first tranche is providing the owner's contribution. That's not the case with indirect financing. This can be a single tranche. And then the final paragraph here is just reemphasizing this is not something new. It's not a new program. It's not a different process. It's just letting you know the markets are opening back up. And so now we have 1, 2, 3, 4, 5 different sources of 100% financing available for real estate. Okay, so now I'm going to dig into your questions and see what you have here. All right, so Demetrius asked a good question about credit. And so is this using personal credit or business credit? Well, you always want to remember each source of capital has its own underwriting criteria. And we've just gone through 5 different sources of capital, so the answers can vary. But we never need to worry about credit, because credit of the 3 C's is the most fluid. So usually with real estate, the credit requirements are low, sometimes non-existent, but at least low. And even if the individual doesn't immediately meet the credit requirements, you and I know we have an ace in the hole with the 60-day credit sweep. So worst case scenario, even if someone comes to us and they don't meet the credit underwriting criteria initially, we're only 60 days away. And I think that's a powerful way to explain it to people. So let's say that I'm talking to Dion, just picking Dion out of the blue here, who's on the webinar. So Dion comes and does not yet qualify for the funding that's best suited for his situation. I'm going to say, Dion, well, it's in just for the clarity, the recording today is on April 2nd. So I could say, Dion, by the first week of June, we'd be ready to go to funding. We need 60 days. Let's get you enrolled in the 60-day credit sweep today. And Dion's going to say, wow, I would qualify for funding, at least from a credit perspective, by the first week of June. Let's do it. Of course, everybody wants sooner, and we know that our loan package process is 28 days, but if people don't meet the underwriting criteria, they're not going to get approved, regardless how many days has gone by. So when we have credit challenged individuals, we love that, right? That's our bread and butter. We work with the individuals that many others won't work with, because we can help them change their eligibility, help them improve their credibility so they can get approved. That's what we do. So thank you for that, Demetrius. Alan's on to one, and I really like this business model. He's got a client that's seeking to buy a mobile home, or what's more politically correct to say, a manufactured housing park. Those are great investments because there's such a demand for affordable housing, and we've done some work in that area. So absolutely, this would be great. It's getting more and more difficult to buy mobile home parks or manufactured home parks because some big companies have swooped in. But yeah, if you can find one that you can go in and purchase, because that model, I digress a bit, is ingenious, right? Because you have pads, and then on the pad is the mobile home. Well, either you own the mobile home, which is a depreciating asset, but it's pretty cheap to buy, especially pre-owned ones, and you can make a good margin, or you allow people to bring in their own mobile homes, or you sell them one. Well, the cost of moving a mobile home is so expensive. What we've seen is mobile home parks can have double-digit annual increases in pad fees because it costs a tremendous amount to move it. You almost have a captive client population. Some people, if they can't afford it, they'll just leave their mobile home behind and just move, and now you have a whole new asset. But yes, so the answer is yes, Alan, this would work. And I love that model of mobile home finance. And I can tell you, there's a number of clients right now that are building mobile home parks. They'll buy 5 to 10 acres. Of course, they'll have to put the water and sewer lines in and the streets in, but it is a hot industry right now. And some of them will go out and buy very affordable units, almost like the Katrina trailers, that they bought that were mobile homes, but really cheaper and plainer and not a whole lot of windows. And, so your mortgage on that is like $200 a month, and you're leasing it out for $800, $1,000, $1,200, $1,400 a month. What a cash flow. So Alan, we'd love to do more of those. All right, and Peggy asked a question, which program is good for purchasing land or a building with land on it? Well, many of these would work. The key is we need to build the loan package and look at the specifics to be able to understand the mitigating circumstances of the client, their business, and the deal, and then we can recommend. And that goes back to the point that I was making before, Peggy. While your question's good and appreciated, I don't want each of you to go out consulting with a client and then getting them excited about one specific type of financing, because you may, well, fix and flip's kind of a category, so that one's fine. But the others, maybe they qualify for that, maybe they don't. And if you go sign someone up and they're only expecting an SBA 504 loan, but they're better suited for something else, then we're going to have unhappy clients. So pitch the concept, but don't pitch specific funding programs, please. All right. Fix and flip. Fix and flip's pretty quick. I'll leave it to the lender to answer some of the specific questions, but we're typically seeing about a 60-day process. All right. Dion's asking some specifics about the payback of fix and flip. And in many cases, we're seeing an interest-only payment arrangement for a certain period of time. But again, the definition of a fix and flip is it's not a long-term loan. It's a short-term loan allowing the investor to buy the property, to improve the property, and then to sell the property. So of course we can build in cost for materials and labor for upgrading or repairs too. And then questions about key man policy. Well, what we all know is that a good loan package has a number of elements. It's almost like a checklist. So a good loan package would have a business plan, would have financial projections, it would have a key person policy. So that is a good element to have. Those are good elements to have in a loan package, regardless of funding source. Okay. Mark says fix and flip is his business. Excellent. So we'll scroll down to that. And are we saying, oh, and he typed this question before I said the rest. So yes, it can be 100% financing for the purchase and the renovation cost. Yes, sir. All right. So Stefan's asking a question, and this is a good one. And I'm glad he brought it up because he's asked me individually, and I don't think I ever addressed it. So what Stefan's talking about are the back end fees. And so we have lowered over time our performance fee for capital raises to 6%. 6%. We pay you half, 3%. And that's mentioned actually down here. What Stefan is asking is, can he charge more? Can he increase that? He wants to charge 9.9 instead of the 6. And the answer is yes. If you want to charge more than the 6, you can charge more than the 6, and you would keep 100% of that markup. We have a different joint venture partner, a veteran. He's coming. He might have come on last night. I've not caught up with the emails, but if not, he's coming on today. And frankly, he doesn't want to charge the client 6%. He only wants to charge them the net of the 3. So yes, Stefan, you have some variability. If you want to increase the performance fee and charge more than the 6, you can do that. And then if you want to rebate back to the client part of the 6 to reduce their performance fee all the way down to 3, you certainly can. Thank you for that. All right, so Peggy's then asking about properties for lease. Well, if we're leasing a property, then it wouldn't be real estate finance, and it would really be just borrowing money to pay the lease payments, the rent payments, and that's what we would call a working capital loan. So that wouldn't apply to anything that we've talked about today. Obviously, it's available. It's a working capital loan. Conversely, she asked about lease to own, and so in that case, the lease wouldn't apply, just like it didn't just a moment ago, but the financing to purchase it certainly would fall under this category. So absolutely, we can do that, Peggy. Okay, Stefan has a different question now. So he's asked, once the 60-day credit sweep is done, can we go directly to first tranche funding? Yeah. So we normally don't want to pursue funding during the 60-day credit sweep process. We need to leave credit alone. We don't want to be opening new trade lines. We don't want to be disrupting the credit profile. Doesn't mean you can't use your open credit cards, but use them reasonably and pay them on time. But the answer to your question is yes, Stefan. Then after that 60 days, we could go to first tranche funding, or we might even skip it at that point. What Stefan's getting to, and it may not be clear to all of you. So normally now in the process, in week 2, we have the personal financial statement of the client if they're in access to capital or capital ready 3.0. And we have the personal financial statement, their soft credit pull. So we usually have enough data at that point to be able to say, okay, here's where your first tranche of financing could come from, even though we've not built the loan package out. The 28 days isn't complete. And so then that can provide funding to pay for the deferred refundable deposit, which is $2,500, which you get half of, and that's referenced here. So it's a refundable deposit to the client, but you keep your $1,250. That's not charged back to you. The point I'm trying to make now, not too clearly maybe, is that if the client's going through the 60-day sweep, then we can hold off on the first tranche of financing until the end of that 60 days. So that would keep them from using their credit during that time. And then their credit will be much, much better, and they'll have a whole lot better options. And so at that point, we could possibly even go for full financing rather than even interim financing. All right, so thank you for that question, Stefan. Looks like we got one more here. No, a couple more. Robert asked, how does this work with orphaned clients? And Robert, you're a machine in mentoring clients. So when you're mentoring a client, Robert, the client's already signed up to either Access to Capital or Capital Ready 3.0. We're handling this part of the discussion. So I would say this is probably not applicable to what you would do as a mentor. Now, does it apply to clients? Of course it does. But in your case, if you're talking about mentoring clients, then you're just trying to focus on getting them through the 4-week process, getting the data in that we need, keeping them compliant. So I think it's apples and oranges, but maybe I'm missing it, Robert. All right, so Dion's into another interesting one, container houses, another growing, it used to be about tiny houses, and we've had our experience with that. Now the movement is towards container houses. All right, so Dion asked about container houses. How would I present this to them? Please, they would like to be the company to go to for when people want to purchase container. Oh, okay, great. Yeah. So what you can offer to do, and that makes a lot of sense, is develop a referral partner with the people that are, I guess in your case, Dion, selling the containers. I don't know if they're doing the build out or just simply selling the containers. And so you could set up a referral relationship with them, Dion, to say, hey, we'll provide financing for your clients. We'll get them financing for the purchase of the container and the rehab cost, and they would just refer all those people to you. If you want to do some sort of revenue share with them, you can. And if you don't want to, you don't have to. Pretty much everybody now seems like are becoming joint venture partners because we waived the fee. Remember, it used to be $100,000 to be a joint venture partner. Then we reduced it to $50,000. And then we started giving back $25,000 of working capital. And now it's evolved to the point, as of April 1st, we talked about this a couple of days ago, you can be a joint venture partner at no cost now. So joint venture partners earn $1,250 of the $2,500 refundable deposit, again, refundable to the client, but you keep the $1,250. It's not charged back to you. And then instead of earning 1% of the capital raise, you're getting 3%. So nearly everyone, I think, has migrated over to be a joint venture partner because we've eliminated the cost and you make like 3 times as much. So the point with that is, we're all in at that point, Dion. You're making the $1,250 and the 3%. If you wanted to revenue share with your referral sources, that's up to you. You don't need to sign them up as an affiliate. You don't need to put them in our system. You do whatever deal you want with them and you pay them out of your portion however you want. Great idea, Dion. That's exactly right. You want to go to the key influencers. In this case, it sounds like the people that are selling the storage containers and position yourself to be their financing arm for their clients. That's great. Robert asked regarding orphans, you paid $1,250 and the 3%. Well, there's an orphan client doesn't mean that they didn't have a referral source. Of course they did. It means that the referral source does not want to do the mentoring. So if we paid you, Robert, $1,250, and then we paid the referral source $1,250, that would completely deplete the refundable deposit. And if we paid you 3% of the capital raise plus the referral source 3%, that would completely deplete the capital raise. So that math doesn't add up. So this, just to clarify, so this would be relevant if you generated the client. If someone else generated the client, then they get paid this. That's kind of the way commissions work. All right, Scott Latunti's got a question. So even though we put someone into access to capital during their 60-day credit sweep, their access to capital program is essentially put on hold. No, I wouldn't say that at all. What we're saying is that if you enroll someone in access to capital, we get to week 2 and we look at their circumstances for first tranche financing, their 3 C's. And it may be advisable, rather than collecting the deferred refundable deposit from them at that time, to instead get them in the 60-day credit sweep so they become much more credible, much more eligible for funding. We'll continue to work with them, but in that case, we would defer the collection of the refundable deposit until they came out of the 60-day credit sweep, for the reason we just mentioned. We don't want to use their credit. We don't want to alter their credit when they're going through the sweep process. Yeah, that was my fault, not Scott's. I wasn't clear enough on that. So granted, this is a great out for clients. So let's say they get to the second week point and we find out they're not credible enough for any first tranche financing. Well, what do? In the past, we drop them into the safety net loan, which is a good deal, right? 0%, and they pay low $100 payments. But if they don't want to do that or can't do that, then they're out on that is to one of 2 things: either just pay $2,500 out of pocket, which you'd be surprised how many people actually do that, or the other would be, well, you've got credibility issues. Let's address the core problem. Let's get you into the 60-day credit sweep. We'll further defer collection of the refundable deposit for 60 days. Let's get your credit where it needs to be. And then now the world's your oyster in terms of funding. Yeah, as Stephen said, maximize your credit score, then go for funding. But we always want to remember there are some sources of capital that are not credit specific. So if we're going to go after a type of capital that's not dependent upon credit, then it wouldn't make sense for us to say, oh, don't worry about the refundable deposit, because they may qualify for funding that's not credit specific. All right, so let's wrap it up, because I've ran 7 minutes long, haven't I, on this Good Friday. So today is April 2nd. We had training talking about a number of different 100% financing real estate options. We talked about SBA 504 loans, love them, love them, love them. We talked about alternative long-term real estate financing. We talked about fix and flip financing. Again, all of these eligible for 100% financing. Private lender financing. And then I think an often overlooked approach is indirect financing, because it's pretty cool to own a home that you have no mortgage on. And this is the quickest way to do that. Let's say you want to own a home, but you don't qualify for a traditional mortgage. Problem solved right here. So there are some creative ways to use these financing models, and then kind of more as intended. But the bottom line is just bring them into the Access to Capital program, as summarized here at the bottom. You're going to make $1,250 on the front end of their $2,500 deposit. You're going to make 3% of the back end. And so, of course, 3% depends. If it's $1 million deal, that's a lot of money, right? If it's a $100,000 deal, it's still good income. It's $3,000 of $100,000, $30,000 if it's $1 million. And again, there is no cap. You know, if it's a $5 million deal, you're looking at, for instance, a 6-figure commission. So it's scalable based upon the size of the deal. All right. Thanks, everyone, for your time. We'll be back Monday morning, and we should have a really exciting topic ready to go on Monday, talking about one of the other 3 C's. We've investigated enough on credit. Now we're going to dig into one of the other 3 C's. So we'll see you Monday morning. Have a good holiday weekend. Bye-bye.